Donating $100,000 to charity shouldn't cost you an extra $21,000 in tax. But that's exactly what it does if you don't have a plan around how you are going to donate that money. Let's say you have a stock that's highly appreciated, and in October, you sell that stock. Next April, you're going to get a capital gains tax bill for it. But every year in December or January, you and your family write a large check and you give cash to charity. That right there is where you just lost $21,000 in tax on a six-figure check to your church or a philanthropic cause you're passionate about. Take it a step further. Let's say you're in retirement, you're 75 or older, and you're getting pretty significant required minimum distributions, but you and your wife, you give every single year to nonprofits that you're passionate about. If you're giving cash instead of your RMD through what's known as a QCD, you're leaving tax dollars on the table just because you don't have anyone that is familiar with IRS tax code giving you advice and helping you build a plan. So in this video, I'm going to actually show you the wrong way and a few of the right ways. And by right, I just mean efficient and effective ways that you can maximize the power of your giving while minimizing the burden you experience from a tax standpoint. And I'll even walk through a tool that allows you to get your deduction today, but grant that money to charities in the future. This video is for education only. It's not investment advice. It's not tax advice. Your situation is unique. Tax laws could change. This is going to depend on your income tax bracket, your capital gains situation, where tax laws go, what state you live in, and a few other factors. The only way to actually know what does and doesn't apply is to do the math and work with someone for your own situation. After all, it's called personal finance. So at 49 Financial, we have a joke, and I actually don't know who coined it, so I can't give credit, but we just say friends don't let friends give cash. And so the problem here isn't your intent. You're already set up and you're already giving and you want to keep giving. The problem is that there's actually a more effective and efficient way that you can go about doing this. You have your bank account over here. You have a charity over here, but we also have this thing called a brokerage account or a non-retirement investment account here. And in between those three, that's where efficiency is to be had and to be found. And so what I've done here is I've put a slide up that just gives you a little bit of how charitable giving creates a tax benefit for you. If you already know this, great. If you don't, hit pause, give it a read. So I want to introduce a DAF, as we call it, or a donor advised fund. So donor advised fund is a charitable giving account. And so the way this functions is when I take cash or stock and put it in this account, I get a tax deduction. So let's say I do that in July. In July, I move cash or stock to this account. I get my tax deduction in whatever year that is. This year happens to be 2026. But what's unique about this account is I can hold the money in this account for really as long as I want to. In fact, I could let my children inherit this account, and then they could be the ones to grant the money from the donor advised fund to a charitable organization in the future. Now, why is that important? Well, number one, I might have a highly appreciated stock, or a real estate transaction, or a business transaction that's going to create a tax burden that I want to plan around. But I might not want to give all of that money to my church or the nonprofit today. I might want to grant it out over time. And so I get the benefit of the tax write-off today when I put the money in the donor advised fund, but I also have the benefit of time to make a good decision, to pray over that decision as time goes on before I give that money away because of the donor advised fund. Now, what's cool, that money I give today doubles in value while it's in the donor advised fund. Guess who pays tax on that? Not me, not the charity. It's tax-free growth. And so there's some extra value that comes from that. So here's another slide to walk you through some of the mechanics, but we're going to dive into this. We're going to start unpacking this a little bit further. So let's use stock as an example. If you donate cash, and we're going to use a 15% capital gains tax rate here, selling shares and donating cash. Okay. So you sell shares, you have a 15% capital gains tax. That's the tax you pay. Now you might be saying, well, Patrick, what about your cost basis and gain and this? Yes, I know it's complex. It's nuanced. This is for conceptual purpose because your situation is going to be unique anyways. So So you donate cash, you give $100,000 to charity, you pay your $15,000 in tax. Well, yeah, it actually costs you an extra 15 grand, right? You wanted to give 100 grand to charity, but the IRS took 15. They were owed it. So we had to come up with another 15 on our own. Or we sell 100,000 in stock and the charity only gets 85 because we had to earmark 15 for the IRS. Now, we did get the, $100,000 tax deduction because we gave 100 to charity, but, it cost us. Now, if we donate appreciated assets, we avoid paying the capital gains tax. We give $100,000 to charity and we get a taxable deduction. And so this reads left to right? Donate cash, $0 in cap gains. Charity gets 100. We get $100,000 tax deduction. Well, if we sell shares, we pay that tax. Charity gets 85. Or we got to come up with an extra 15 out of pocket and we get an $85,000 income tax deduction. And then if we donate the stock, $0 in tax because we gave it away, $100,000 to charity, we get the $100,000 income tax write-off. So it's very similar to giving cash. At this point, you might be like, Patrick, why would I do that? Why do I not just keep giving cash? Stick with me. What we would advise our clients to do is set your brokerage account up. We're going to give that appreciated asset to the donor advised fund or the DAF account. You get an immediate income tax deduction. When the time is right, we're going to give that appreciated assets to a charitable organization of our choosing. Now, if we double click in and we're using the federal long-term capital gains tax, right, getting our numbers a little bit more dialed, a little bit more specific. In this scenario, the capital gains tax, if our cost basis was $10,000, would be $21,420, net to charity a little over $78,000. And we just call this giving brilliantly, right? Using little tools in our toolbox to make a big impact. That is how we get to where we're going. Now, if we donated the securities, one of the things I want to see that you realize here is that word in the bottom left, avoided. We actually avoided $21,420 in capital gains tax. Now, again, you might be saying, I can give cash, I can do the same thing. Well, the impact of this actually plays out over time. You love Apple stock, Nvidia stock, Tesla stock. Maybe you're all in on SpaceX stock and you don't want to sell the stock because you think it's going to keep going up. Well, the problem is eventually you're going to have a really, really big gain exposure, or at least I hope you do. That means you made a lot of money. And you don't want to sell the stock because of the capital gains tax. And you don't want to sell the stock today because you think it's going to keep going up. So here's what we do. We give the stock from your brokerage account. We take the cash that we were going to give to charity and we buy that stock right back. There's no wash sale rule there. The IRS isn't going to get upset with us for doing it because we didn't sell it and buy it. We gave it and bought it. And when we do that, we're pushing your cost basis up. That's significant because eventually when you want to sell that Tesla, Amazon, Nvidia, or Apple, or whatever stock it is that's appreciated a lot, we've pushed your cost basis up over time. What does that mean? It means we pay less tax when we decide to exit that position. This chart outlays that perfectly for you. Again, I'm going to give you all the benefit of the doubt of being able to read and understanding what I just walked through. So let's say we originally purchased 50 shares of XYZ stock at $1,000 a share. If it goes up to 2,000, assuming a 15% rate, because I want my math to be easy, right? What happens? 50 shares, $1,000 a share. I got 50 grand. It doubled in value. I have 100 grand. My future gains 50, 15%. I owe 7,500. So now let's assume that the stock went up in value, but I gave it all away. It went up, 50%. And I gave it all to charity, but then I bought it again. Okay. So now my cost basis is 75,000. It still makes its way up to 100, but my gain is 25,000. So when I sell, see that tax savings there at the bottom? It's pretty significant. Now play that out over years and years and years and years and years of giving and bigger and bigger and bigger dollars, it really starts to add up. So in my opinion, when do you use a donor advised fund? Well, it's really kind of twofold. Number one, when you don't want to give all of the money to charity at once because maybe it's inappropriate and it's more helpful to grant it to them monthly. But we want our tax deduction today. Donor advised fund makes a lot of sense. Number two, if we don't know which charitable organization we want to give that money to right away and we want time to make that decision, donor advised fund allows for that. Now, I am not a charitable giving expert. The beautiful thing about 49 Financial is we have a team whose whole job is to help you maximize the power of your giving, and maximize the potential tax benefits that come along with that. And charitable giving is just one part of your tax plan. I talked about QCDs, which is a qualified charitable distribution that impacts your required minimum distribution. The IRS loves 3-letter acronyms, IRS. Okay, I'm not that funny. There's a reason I'm here on YouTube and not doing stand-up comedy. But there's lots of different levers we can pull in our tax planning and in retirement. And qualified giving through IRAs or charitable giving through brokerage accounts or cash is just one of those. One of the bigger tax questions in retirement is really how you plan on getting your money out, which accounts you plan on pulling from, when you plan on pulling from, Roth conversions, and so many other topics. Click here and I'll walk you through a hypothetical example of a client that entered retirement with no plan versus one that did.